Welcome to NextGen Investors, where future meets fact. From August 1, 2025, the United States has officially imposed a 25% tariff on Indian exports, citing high Indian duties, a growing trade deficit, and India's continued military and energy ties with Russia. This bold move is expected to hit key sectors, shake the stock market, and pressure the rupee against the dollar. In this video, we'll break down what these tariffs mean, which sectors are most affected, what could happen to the rupee, and how you can position yourself as an investor. Stay with us till the end. This is not just a story of risk, but also of strategy. Why did the US impose 25% tariffs? The US claims India has high tariffs on American goods. A $40+ billion trade surplus with the US. Continued energy and defense deals with Russia, ignoring US-led sanctions. The tariff applies to multiple Indian sectors, marking a new trade tension between the two democracies. Cut to graphic, 25% tariff, not just about trade, it's geopolitics too. Impact on key export sectors. 1. Textiles and apparel. India exports over $8 billion to the US. Tariffs erase India's cost advantage versus Vietnam, Bangladesh. Jobs in Tirupur, Surat, Noida under threat. 2. Gems and jewelry. India is a global diamond hub. 25% tariff equals huge price spike equals demand drops. Value chain from karigars to exporters will feel the pain. 3. Pharmaceuticals. US depends on Indian generics. Some exemptions exist, but uncertainty is rising. Regulatory pressure plus tariffs equals dual blow. 4. Electronics and components. Apple suppliers and mobile exporters hit. May force US firms to rethink India sourcing. 5. Leather, seafood, auto parts. Smaller sectors but large rural employment ripple effect. Rupee versus dollar impact. What happens to the rupee now? Export slowdown equals less dollar inflow. Foreign institutional investors may pull out from vulnerable sectors. Current account deficit (CAD) may widen. Oil prices rising due to global tension? Another blow. Expected US dollar to Indian rupee range. From 83.5 Indian rupees today, risk of hitting 85 Indian rupees to 87 Indian rupees per USD. RBI may intervene, but global risk-off mood equals rupee weakens anyway. Indian stock market impact. Let's talk about Dalal Street. Sectors likely to face heavy selling. Sector stocks at risk. Textiles. KPR Mill, Gokaldas Exports, Raymond. Gems/jewelry. Titan, Rajesh Exports. Pharma. Lupin, Sun Pharma, only if generics face tariffs. Electronics. Dixon Tech, Amber Enterprises. Auto parts. Motherson, Bharat Forge. Short-term effect. Nifty may face a correction. Export-heavy companies will lose margins. Investor sentiment weakens. Sectors safe or positive. IT and tech, digital exports not affected, Infosys, TCS, HCL. Domestic FMCG, focused on Indian demand, HUL, Nestle. Banks/NBFCs, indirect impact unless macro worsens. FII behavior. May exit vulnerable sectors. But long-term investors may wait for buying opportunities. Economic impact and GDP. GDP impact. Economists predict a hit of 0.2 to 0.4%. Export-linked jobs affected, especially in MSMEs. Pressure on labor-intensive sectors equals rural income drop. Widening trade deficit. Less export plus still heavy imports, especially oil. CAD rising may scare rating agencies too. India's response and strategy. India, what is the Indian government planning? Studying WTO complaint. Bilateral back-channel talks in Washington. Exploring export subsidies and tax cuts for affected sectors. Accelerating FTAs with EU, UK, ASEAN to reduce US dependency. boosting domestic demand to support MSMEs. Government statement. We will protect our national interests, diplomatically and economically. What should investors do? Opportunities in crisis. Buy on correction in strong companies hit by panic selling. Focus on diversified exporters, not single market dependent ones. Look for IT, FMCG, infra stocks with no US exposure. Consider hedging rupee risk if trading in USD assets. Don't panic. Strategize. This could be a temporary move. Many believe US may settle for lower tariffs through negotiation. Conclusion. The US-India trade relationship is going through a storm. Yes, the 25% tariff will hurt Indian exports, affect the rupee, and shake investor confidence, but India has handled worse. It's a test of diplomacy, strategy, and market patience. As always, we'll keep watching the numbers and the facts. This is NextGen Investors. Subscribe now for sharp, fact-driven updates on global events that impact your wallet. Until next time, invest smart, stay informed.